Welcome to today's Explainer, everyone. We are diving into a company that is absolutely dominating the financial news cycle right now. If you have glanced at your stock screens at any point recently, you have undoubtedly seen Broadcom stock going completely parabolic. I mean, the charts are literally pointing straight up, and everyone is asking the exact same question. Are we witnessing a true fundamental, data-backed rally here, or is this just another speculative AI bubble waiting to pop and wipe out our portfolios? To help us decode this whole situation, I have brought in our chief investment analyst. Doctor, it is absolutely great to have you here today.
Thank you for having me. To answer your question right out of the gate about whether this is a fundamental reality or just a speculative bubble, we have to strip away the emotion. When we look strictly at the raw data from their recent earnings reports and market releases, there are three very real, measurable causes hidden behind these flashy news headlines. First, the data shows an unprecedented acceleration in global demand for custom AI accelerators and AI networking chips. Second, we are tracking massive, consistent cash generation from their infrastructure software segment. And third, Broadcom is currently establishing a monopoly-like grip on the next generation of broadband connectivity, specifically through a technology called Edge AI and their new Wi-Fi 8 rollout.
Okay, we are definitely going to dive deeply into all of that. But before we get lost in the weeds of AI accelerators and network connectivity, for the viewers who might be looking at their stock accounts and are completely unfamiliar with this massive company, what do they actually do? Give me a simple analogy that even an elementary schooler could understand.
Let's frame it this way. If artificial intelligence is a fleet of millions of ultra-fast sports cars, Broadcom does not build the cars. Instead, Broadcom constructs the concrete highways, the traffic control systems, and the high-speed fast lanes that allow those cars to travel from a massive cloud data center all the way to the smartphone in your pocket without crashing or slowing down. They are essentially building the physical digital infrastructure of the entire AI economy.
Wow. Okay, look at this number on the screen, 47.4%. The data we are pulling up right now from investing.com shows a massive 47.4% expected sales increase. Now, I have to play devil's advocate here for a second. When I see a legacy tech company as big as Broadcom projecting a near 50% jump in sales out of nowhere, my alarm bells immediately start ringing. Isn't this just pure market hype, or Wall Street analysts just getting carried away slapping the AI buzzword on everything?
The sentiment in the market right now is not based on hype. It is based on mathematical projections of their actual order book. If you look at the data here from investing.com, while sales are expected to increase by 47.4%, their earnings are projected to rise even faster, coming in at a 51.6% increase. Institutional analyst sentiment has objectively improved based on these billing realities. Price targets have been aggressively revised upward, rising from $216 per share just 90 days ago to $240 per share right now. Furthermore, these estimates have been consistently revised higher over the last 7 days leading into their next reporting cycle.
Really? No way. So the major analysts are actually doubling down on these massive targets right now, even after the run-up?
It is entirely proven by the numbers. Barron's recently published an analysis including Broadcom among a very short list of just 5 stocks that have gone parabolic recently, but still have the underlying fundamental backing to continue performing well. This growth is heavily tied to their AI-related demand, which, again, is not some speculative future concept they are promising for 2030. It is a current, build reality reflecting right now on their income statement.
So what you just said basically means this 47.4% growth isn't a random guess. It's a hard calculation based on the actual digital highways they are building and billing their customers for right this very minute.
Precisely. Let me expand on that highway analogy by looking at their actual product portfolio. Their business model is structurally split into two highly technical but very synergistic pillars: semiconductor solutions and infrastructure software. On the semiconductor side, they design the incredibly complex application-specific integrated circuits, which are known as ASICs. They also build the Ethernet switches and the fiber optic modules that physically connect all the servers inside massive data centers. Then on the software side, they provide the enterprise security and mainframe software that manages, routes, and secures all that traffic across the network.
Okay, I think I'm getting it. So they own the road, and they also own the toll booths and the security cameras monitoring that road. That sounds like an incredibly lucrative setup. But enough of the analogies, let's start looking at the hard cash. Show me the receipts, doctor! The Q2 2026 earnings report gives us those definitive receipts. If you examine the figures, net revenue for the second quarter came in at an astounding $22.187 billion. When we compare this directly to Q2 2025, which saw $15.004 billion in net revenue, we are looking at a 48% year-over-year revenue explosion.
Oh my gosh, a 48% jump? Adding over $7 billion in pure revenue in a single quarter compared to the previous year? That is literally the size of an entire Fortune 500 company, just in sheer quarterly growth.
It is a remarkable scale of expansion. However, as an analyst, it is crucial to examine the underlying profitability of that revenue, not just the top-line growth. The Q2 GAAP net income landed at $9.31 billion, which is up 88% from the prior year period. But the most important metric here is their cash flow from operations, which hit $10.493 billion. If we subtract their capital expenditures of $231 million, we arrive at $10.262 billion of free cash flow. That free cash flow figure represents a staggering 46% of their total revenue.
Wait a minute, doctor. Stop right there. Free cash flow representing 46% of revenue, that sounds great in a finance textbook. But what does that actually have to do with our stock accounts? What does that mean for the regular, everyday investor watching this explainer?
To put it in the simplest terms, it means that for every single dollar Broadcom makes in sales, 46 cents is converted into pure, unencumbered cash that can be used directly to reward shareholders. They don't need to spend it on keeping the lights on. Because of this massive cash generation, during this exact same quarter, they paid out a cash dividend of $0.65 per share. That totals $3.092 billion flowing directly back into the pockets of investors.
Okay, so they are essentially a cash printing machine. We know they are making mountains of money, but where exactly is this $22.2 billion coming from? How is it actually split up within the business? The Q2 revenue split tells the complete story of their current operational leverage. It is strictly divided into two distinct segments. First, Semiconductor Solutions generated $15.009 billion. This represents 68% of their total net revenue, and it is a 79% increase year over year from the $8.408 billion they reported last year. Second, Infrastructure Software generated $7.178 billion, representing the remaining 32% of total revenue, which is a 9% increase year over year. A 79% jump in the semiconductor segment alone? That's insane. It is. But what is even more analytically significant is the operating leverage they are achieving. Their adjusted EBITDA, which is a metric that measures operational profitability before accounting tricks, was a record $15.244 billion for the quarter. That equates to an adjusted EBITDA margin of 69%. A 69% margin? Wait, let me get this straight. You are telling me they are operating a physical hardware and physical chip manufacturing business, but they are pulling in the profit margins of a pure software or app company. How is that even physically possible in the real world? It is entirely possible because of the specific, highly specialized, high-value nature of the silicon they are selling. They are not selling cheap, commoditized chips that anyone can make. They are designing and selling the absolute most advanced mission-critical infrastructure required for the world's largest technological shift, and they possess immense pricing power because their clients simply have no alternative. All right, you mentioned the technological shift. I want the exact number on that. Out of this massive semiconductor explosion, how much of this hardware growth is actually being driven by artificial intelligence?
The specific hidden driver behind this 79% overall semiconductor growth is entirely AI. In Q2, their semiconductor revenue derived specifically from AI applications hit $10.8 billion. That represents 143% year-over-year growth in that subsegment alone.
143% growth in just the AI segment.
So it's not a myth, correct? It is proven on the balance sheet. According to Broadcom CEO Hock Tan, this massive surge was driven by accelerating above-forecast demand for two highly specific components: custom AI accelerators and AI networking hardware. Hyperscale cloud providers simply cannot physically build their massive AI data centers without Broadcom's customized routing and switching silicon.
In other words, cloud giants like Google, Meta, and Microsoft physically can't build their massive multi-billion-dollar AI supercomputers without paying Broadcom's toll first.
But I am going to push back here, because this is where a lot of retail investors get trapped. They are making good money, sure, but investing.com points out a really glaring issue on the screen right now. Broadcom's historical earnings surprises tend to be very, very small. Last quarter, the earnings surprise was a tiny 1.3%. If they are barely scraping past Wall Street's expectations by a single hair, why is the market valuing them so highly? Why is the stock going parabolic if they aren't completely blowing estimates out of the water? Isn't this exact scenario proof of a short-term AI bubble where the market's expectations are already totally maxed out? That is a common misconception, but the data indicates the exact opposite. The market isn't rewarding Broadcom for unpredictable, massive upside surprises. It is rewarding them for deterministic, highly reliable growth. A 1.3% surprise on a mathematically forecasted 48% total revenue jump indicates that management has incredible, almost unprecedented visibility into their long-term order book. They are executing flawlessly on a massive global scale without any operational variance.
Oh, I see. So what you just said basically means that being boringly predictable while growing at nearly 50% is actually their biggest flex.
Exactly. The financial markets assign a massive premium valuation to sustainable, predictable monopolies. And to truly understand why this growth is structurally sustainable long-term, we have to examine their industry environment and their economic moat. Specifically, we need to look at how they are positioning themselves far beyond the traditional data center.
This transition brings us to Broadcom's ultimate technological differentiator and economic moat, Edge AI. According to Broadcom's own product releases, Edge AI involves processing artificial intelligence algorithms locally, directly on a hardware device, using an embedded neural processing unit, or NPU, rather than routing all that user data back to a centralized cloud network.
Hold on, Doctor. We are drifting into some seriously heavy tech jargon here. Edge AI and NPU? That's too complicated. How does this actually translate to an investor's bottom line? Give it to me simply. Think of it this way. Right now, when you talk to an AI voice assistant on your smartphone, your voice data has to travel all the way to a massive data center hundreds of miles away. It gets processed there, and then the answer has to travel all the way back to your phone. This physical distance creates a delay, or what we call latency. Broadcom is taking a piece of the AI's brain, that is the NPU, and putting it directly inside the hardware, like your home Wi-Fi router. Oh wow, so you're saying the AI is essentially living right inside my house, right on the device itself? Exactly. By placing the AI compute engine locally at the edge of the network, the device can orchestrate tasks instantaneously without relying on the cloud at all. This provides deterministic low latency and fundamentally secures user privacy, which the industry acknowledges is absolutely essential for the next generation of instantaneous, conversational AI agents to function properly.
Got it. So the core issue here is that conversational AI is completely useless if it lags. If I ask my AI assistant to turn off the lights or answer a question and it takes 3 seconds to respond, the illusion is broken. Broadcom is literally fixing the lag. The execution of this strategy is clearly evident in their new broadband Edge AI portfolio. They have officially introduced a complete Wi-Fi 8 silicon ecosystem to the market. This rollout includes highly integrated dual-band systems on a chip, or SoCs, specifically designed for the residential market. Most notably, they introduced the world's first 50G ITU PON gateway SoC that features an embedded neural processing unit. 50G PON. What does that actually do in the real world? It enables multi-gigabit, sub-millisecond connectivity directly to the home. Furthermore, by unifying the traditional CPU and the new Wi-Fi 8 radio onto a single piece of silicon, Broadcom has engineered a verifiable 50% reduction in active power consumption compared to previous generations of hardware. This physical moat, which combines extreme speed, localized AI processing, and massive energy efficiency, solves the fatal latency flaws of conversational AI. This technological leap secures a massive, irreplaceable competitive advantage in the global market.
And this explains exactly why they are winning so big. They aren't just staying in those massive data centers we hear about on the news, they are actively trying to own the router sitting in my living room right now.
They're doing exactly that on a global scale, specifically through a major strategic collaboration with Samsung Electronics. The data shows they have unveiled the world's first integrated 5G and Wi-Fi 8 fixed wireless access, or FWA, platform. This unified platform combines Broadcom's BCM676 Wi-Fi 8 SoC directly with Samsung's B1320 5G modem.
Fixed wireless access. Okay, so that means replacing the physical fiber optic cable that currently runs under my yard to my house with a 5G wireless connection that just beams the internet straight to a box sitting in my window.
Correct. As global broadband demand shifts, major mobile operators desperately want to offer fiber-level broadband speeds to consumers without incurring the massive, prohibitive infrastructure costs of digging up streets to lay physical cables. The Samsung modem achieves 5G downlink speeds of 3.43 gigabits per second and uplink speeds of 1.17 gigabits per second. When that is paired with Broadcom's advanced Wi-Fi 8 chip, it delivers a consistent, ultra-reliable, zero-latency experience to every single corner of the home.
And this specific platform is designed entirely for mass-market scalability. The Samsung modem supports the new 3GPP Release 17 standard, and the Broadcom BCM6776 includes a quad-core ARM network processor that natively supports 4-stream 160 MHz channels in both the 5 and 6 GHz bands. It also features dual PCIe Gen 3 controllers.
Whoa, let's pause right there. This alphabet soup is getting way too thick for me. What does a Gen 3 controller or Release 17 actually mean for someone holding Broadcom stock in their retirement account? We need the bottom line here.
Fair enough. All of those complex technical specifications translate into one vital, undeniable financial metric for the companies building these boxes: drastically lower costs. Unifying the CPU and the Wi-Fi 8 radio significantly reduces what is known as the bill of materials, or BOM, for original equipment manufacturers, also known as OEMs. It vastly simplifies the physical board design.
Got it. So what you just said basically means Broadcom makes it way cheaper and easier for hardware companies to build these super fast 5G home routers, meaning every internet provider on Earth is going to want to buy Broadcom's chips just to save themselves money.
That is factually correct, and early market adoption proves this thesis. Leading OEMs like Humox Networks and WNC are already integrating this exact platform into their next-generation gateway portfolios. Broadcom is rapidly securing mass-market dominance before competitors can even react.
To put it simply for everyone watching, Broadcom isn't just riding the AI wave. They are literally building the surfboard, they are filling the ocean, and they own the beach. They are locking down the entire ecosystem from the data center to the living room.
Exactly. And when we look at the upcoming Q3 fiscal year 2026 guidance, that ecosystem lockdown is exactly what brings us to their future financial projections, which are the core basis for the current stock valuation.
Let's see those forward-looking numbers. What are we expecting?
The official third quarter revenue guidance is projected at approximately $29.4 billion. This represents an astonishing 84% increase from the prior year period. Furthermore, management expects the semiconductor revenue derived from AI alone to grow over 200% year over year, hitting $16.0 billion in Q3. Their non-GAAP operating margin is also expected to remain highly stable at 67%, which reflects their continued exceptionally strong operating leverage despite this massive scaling.
84% growth to $29.4 billion in a single quarter? That is a staggering, almost incomprehensible amount of money. But the stock market is ruthless and nothing is guaranteed. Let's map this out clearly for the viewers. What are the actual survival scenarios we are facing as investors here? Based strictly on the empirical data and the outlined risk factors in their SEC filings, we can project 3 specific survival scenarios for the stock. First, the bear case, or the pessimistic scenario. The primary trigger here would be a sudden cooling of the broader speculative AI market rally, combined directly with Broadcom failing to continuously beat these sky-high expectations. Remember what we discussed earlier. With a historical earnings surprise margin of only 1.3%, there is virtually zero margin for error. If hyperscale cloud providers suddenly delay their custom ASIC orders due to macroeconomic conditions, or if this massive Wi-Fi 8 mass market rollout faces unexpected supply chain disruptions, the stock price will contract violently to align with a much lower growth multiple. Right, if you are priced for absolute perfection, any tiny stumble is a massive, painful fall. What is the base case then? The base case, which is the neutral and statistically most likely future based on the current data trajectory, is that Broadcom flawlessly executes its existing pipeline. Steady global adoption of the Samsung FWA platforms and their Edge AI routers allows them to hit that forecasted $29.4 billion Q3 target right on the nose. In this specific scenario, the stock maintains its current premium valuation, heavily supported by that massive 46% free cash flow generation and their consistent lucrative dividend payouts. And finally, the bull case. What happens if everything goes straight to the moon? The bull case requires their AI semiconductor demand to accelerate even faster than the current historic run rate we are seeing. The specific trigger here would be AI semiconductor revenue completely shattering the projected $16.0 billion mark, indicating a 200+% year-over-year growth rate. If enterprise adoption of Edge AI orchestrators suddenly becomes legally or operationally mandatory for security and latency reasons, Broadcom's moat deepens significantly. This would trigger immediate further upside target revisions from institutional analysts, undoubtedly pushing the stock to new all-time highs.
You know, looking at all this famous quote by the legendary Benjamin Graham perfectly captures Broadcom's exact situation right now. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. While the broader retail market might just be voting emotionally on AI hype in the short term, driving prices up and down, Broadcom is busy in the background stacking the scale with actual, undeniably heavyweights, $10.2 billion in pure free cash flow, 69% profit margins, and what looks to be a complete monopoly on the physical hardware of our Edge AI future. They really aren't selling dreams here. They are literally selling the concrete for the digital highway. Doctor, thank you so much for bringing the hard data and cutting through the noise today. And to our audience, what do you think? Are Broadcom's massive software-like margins truly sustainable long-term, or is this AI hardware boom nearing its absolute peak? Let us know your thoughts down in the comments below. Thank you for joining today's Explainer. Your subscriptions, likes, and supportive comments are a huge encouragement for our video production and help us keep bringing you these deep dives. See you in the next one.